Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now that you know the basics, let's compare the risks, returns, and key factors to consider when choosing between corporate and government bonds. Cons of investing in corporate bonds. While the higher yields are appealing, corporate bonds also come with distinct drawbacks you need to understand before investing. Consider these potential downsides. Increased credit risk. The biggest risk with corporate bonds is credit risk, also known as default risk. This means the issuing company might not be able to make its interest payments or repay your principal. If the company's financial health declines, your investment could suffer. Impact of company performance. The value and stability of a corporate bond are directly tied to the performance of the issuing company. Poor financial results, industry downturns, or even negative news about the company can cause the bond's value to drop. Would you lend money to a struggling business? Lower liquidity? Compared to government bonds, many corporate bonds can be less liquid. This means it might be harder or take longer to sell your bond on the secondary market if you need to access your cash before the maturity date. You might also have to accept a lower price when selling. Key differences and considerations for investors. Now that you understand the basics of both corporate and government bonds, let's look at how they stack up against each other. For you as an investor, recognizing these distinctions is crucial for building a portfolio that aligns with your financial goals and risk comfort. What really matters when you're deciding where to put your money? Risk and return trade-off. Every investment comes with a balance between risk and potential return. It's an inverse relationship. Higher risk often means higher potential returns, but also a greater chance of losing money. On the flip side, lower risk typically means lower returns. With government bonds, you're usually looking at the lower end of the risk spectrum. Why? Because the government has taxing power and can print money, making default very unlikely, especially for stable economies. This safety means they offer modest interest payments. Corporate bonds, however, live higher up on that risk ladder. Companies can face financial difficulties or even go bankrupt. Because of this added risk, they must offer higher interest rates to attract investors like you. It's their way of enticing you to take on that extra uncertainty. Are you comfortable chasing higher returns for a bit more risk? Credit ratings and their importance? So, how do you know how risky a bond is? That's where credit rating agencies come in. Organizations like Standard & Poor's, S&P, Moody's, and Fitch assess the financial health of bond issuers. They assign ratings to both governments and corporations, telling you how likely the issuer is to pay back the debt. Here's how it generally works. Higher ratings, e.g., AAA, A, mean lower risk, suggesting the issuer is very likely to meet its obligations. Bonds with these ratings usually offer lower yields. Lower ratings, e.g., BBB, B, indicate higher risk. These bonds generally offer higher yields to compensate investors for the increased chance of default. For you, these ratings are a quick guide to a bond's safety. When you see a low rating for a corporate bond, it signals a greater chance of default, which is why it might offer a higher yield. Always check the credit rating before investing. Impact on portfolio diversification. Building a smart investment portfolio is all about diversification. You don't want all your eggs in one basket. Incorporating both corporate and government bonds can create a more balanced and robust portfolio for you. Consider these points. Government bonds serve as a stable foundation. They can help preserve capital and act as a safe haven during economic downturns, cushioning your portfolio when riskier assets struggle. Corporate bonds offer higher yield potential, giving your portfolio a boost. They allow you to participate in the growth of various industries, but with more risk than stocks. By holding both, you can balance your desire for higher returns with your need for stability. It's like having both a sturdy shield and a powerful sword in your investment arsenal. Market factors influencing bond prices. Bond prices don't stay still. Several broader market factors can affect their value, influencing both corporate and government bonds. Knowing these can help you understand why your bond's value might change. Key factors include interest rate changes. When overall interest rates rise, newly issued bonds offer higher interest payments. This makes older bonds with lower rates less attractive, pushing their prices down. Conversely, falling interest rates make older bonds with higher rates more desirable, increasing their prices. Inflation. Inflation erodes the purchasing power of your bond's future payments. If inflation is high, the real return on your bond might be low or even negative. This is especially true for fixed-rate bonds. Economic outlook. The general health of the economy impacts bond prices too. During uncertain times, investors often flock to safer government bonds, pushing their prices up. During strong economic periods, corporate bonds might gain favor as companies are seen as more stable, and investors might seek higher returns. Choosing between corporate and government bonds depends entirely on your personal investment strategy. Government bonds offer stability and lower risk, making them suitable for preserving capital and providing a reliable, though modest, income stream. Think of them as a secure foundation for your portfolio. Corporate bonds, while carrying higher risk due to their connection to company performance, offer the potential for greater returns. They can add a growth component and higher yield to your investments. Your ultimate decision should reflect your comfort with risk, how long you plan to invest, and what you aim to achieve financially. Consider your current financial situation and future goals. For many, a balanced approach that includes both types of bonds provides diversification and helps manage different market conditions. If uncertainty remains, speaking with a qualified financial advisor can provide tailored guidance for your unique circumstances. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.